meaning it cash flows and it's basically self-supporting, I'll make that investment. We bought $6 million worth of real estate in June. We're ecstatic we got the property. Uh, and the truth is, maybe the value of that property may drop a little bit more before it starts to go back up.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. My next guest has been a real estate broker and investor for the last 46 years. Started in 1978, built a residential brokerage in Silicon Valley, in the Menlo Park and Palo Alto area, while building his own portfolio of single-family properties around the San Francisco area and across the U.S. Manages and operates a portfolio as a GP and sponsor of over 1,100 units with a total value of around $138 million. Arn, thank you so much for being on the show today. For those tuning in, listening in, tell us a little bit about how you got here today.
Yeah, thanks, Stephen. Happy to be here and look forward to having a nice chat with you. Hopefully, we can help your listeners figure out what to do with their capital and how to create the life that they want. So, typical kind of middle income American kid, grew up Los Altos Mountain View. Parents said school's important, do well at school. And of course, I did fairly well at school, ended up getting a master's degree in physical chemistry, of all things, from the University of Michigan. But through that time, I was a teaching assistant. That's how I kind of paid my way through grad school. I kind of figured out that being in academia or in research probably really wasn't my thing. I wanted to return to the San Francisco Bay Area, and my father had a residential brokerage business in Menlo Park, also known as venture capital of the world, out on Sand Hill Road. So I know many of your listeners are associated with tech, so they're probably familiar with Sand Hill Road. Uh, and in March 1978, went to work for my father, started selling single family homes. Uh, my father was a excellent real estate broker, but he was even a better investor, and he kind of understood the brokerage generates income, but really you need to kind of invest to create that long-term wealth and financial freedom. So he was a big investor in single family homes. And back at those days, you could actually buy houses in the San Francisco Bay Area that made sense as single family rentals. I'd say over my career, about 35 years there, they probably went from average price of 2 to 300,000 to 2 or 3 million. But in any case, I started investing in single family homes, and both in the Bay Area, and fortunately, I found my way to Austin, which of course is another big tech capital of the U.S., and did very well there. About 10 years ago, moved to Greenville, South Carolina, kind of ready for a new lifestyle. I wouldn't necessarily say retirement, but just something new. And right about the time COVID hit, I switched over to multifamily investing, and we can get into that as we chat further.
Yeah, I love that. I didn't know that you went to Austin as well. That's where I'm currently am right now, as you know, and that's interesting. I was gonna call out that I saw that you had the master's science in chemistry as well, and then I saw that you went to do brokerage. I'm like, all right, how did this happen? So I'm glad you mentioned that. It's kind of an interesting pivot.
Yeah. So, I mean, it's interesting how life always unfolds. Maybe some people have a plan and they stick with the plan, but I've also kind of learned serendipity or chance can totally change the direction of one's life. And uh, I just kind of paid attention to what was making me happy. And at the point, I kind of realized academia wasn't my thing, that I kind of wanted more a social environment. And I did very much want to return to the Bay Area. So that kind of drove me there. No long term plan, but That was 1978. Here we are, 2024, and basically real estate's all I've done my adult life. A lot of reasons for that, and we can get into that as we move along.
Yeah, yeah, totally, totally. That's interesting. So you've been doing, like you said, single family real estate for a while. I know that for myself, there was an aha moment from me doing some single family to going to multifamily as well, and I was going through, materials to get to know you a little better for this too, and I heard that one of the things that really kind of, my words just interpreting this, that really kind of opened you up to like bigger multifamily too, was a call that you got from a partner or someone who is going into syndications after, you were already doing two, three, plexes, but that was the moment for you. What was that like? Had you considered going into commercial before that call from the partner?
Yeah, so great question. And interestingly enough, I'm kind of a fitness guy. And when I moved to Greenville shortly thereafter, I'm on the treadmill and there's these two guys just on the treadmills next to me. And you know how guys are. Well, what do you do? What do you do?
Yeah.
What do you do? And it turned out both of them were in real estate. One was a broker and one was just starting investment, young African American kid. I say young, 30 years younger than I am, so age is all relative. And he was just starting his investing career doing single family flips.
Mhm.
And we developed a friendship, great guy, great life story. And March 2020, which, if you reflect back, that's about when we started to understand COVID was a big deal. We started to get inklings January, February, but March 2020 was really where we knew we had a tiger by the tail or some major problem we had to deal with. And he called me up and he goes, "Well, Arn, what do you think's going to happen with rent collections?" And I said, "Mario, I don't know." This was the middle of March. I said, "Mario, I don't know. Call me April 5th and I'll let you know how my April rents came in." And at the end of the day, at the end of the call, he recommended me a podcast, interestingly enough, from another Bay Area guy, another tech guy, a guy named Neil Baba, who's quite well renowned in the space. And I listened to his podcast, and that kind of caused the epiphany for me to kind of move from single family to multifamily. So that was March of 2020. By December 2020, I acquired my first 12 unit building. And by May of 2021, acquired a 43 unit building. And now I've done as big as like 281. So, chance encounter at the gym with a young guy, we develop a relationship. He kind of went to multifamily, and a phone call set the light bulb off in my head. And I think one of the reasons I went to multifamily was we all know there's major issues with housing affordability in this country. And I don't know that there are any easy solutions. The cost of land, cost of construction, labor, material, it's going to go up. It's expensive to build. So, what is the most affordable housing in the US? And typically it'd be apartments or perhaps mobile homes. And so you have a huge demand, huge population segment that needs affordable rental housing. And so I thought it would be a good space to get in. And then the other part of it is when you're a good property owner, a good operator, you take pride in your properties, you're also doing something for the community, i.e., providing decent, safe housing for people who work hard and they just want to go home to a place where the heat works, they can cook their dinner, watch TV, whatever, and live safely and peacefully and quietly within their own home. So it made a lot of sense. The other thing about multifamily is it typically tends to be a joint partnership effort where typically three or four people get together to run these multifamily operations, where single family investing is sometimes more a solitary endeavor. And so I really like the team aspect of multifamily. And of course, having partners allows you to maximize your skill set and do what you really like to do and do what you're good at, while allowing yourself to partner with people who have different skill sets and do things better, other handle other areas of multifamily investing better than you do. So the partnership aspect I kind of really like.
Yeah, it is so much more of a team effort. Like you said, that's the part that you like too. And especially for the reasons it sounded like earlier too, that you like to be a little more social than the academic sense. That's a value that kind of carried you all the way through as well. And it's a lot more fun to do that with the team and do real estate and provide that impact to the community versus it one at a time as well. So there's so many benefits, not only from the individual, but collaboration. You get to do things that you enjoy the most and are good at. So that's a nice kind of in the middle of the Venn diagram, right? From what you enjoy and
Yes.
what you're good at, and partnering, as well as a much bigger impact too. So I definitely see those aspects. There's a lot of things that I enjoy as well, and it's cool to hear through your experience. Those are still the nuggets that you kind of anchor you as well. So since we're talking about, real estate or multifamily and investing at this point, you mentioned some, you know, really sort of why it's great so far, but let's talk about the investing component of it. When we're talking about, what's important to you, which is create your life, the life of your dreams through multifamily passive investing. Talk to me about what that model from your perspective looks like. Like, how does someone invest in multifamily like you're talking about?
Yeah, so great question. So tech professionals of just about any class other than maybe lawyers, attorneys, doctors, they have demanding jobs. They work hard, they're highly compensated, but they earn their salaries and bonuses and commissions. So, uh, very work intensive, long hours, demanding job. Uh, and we all kind of know there's never enough hours in the day, right? By the time you take care of your career responsibilities, providing financially for your family, being there emotionally for your family and friends, volunteering in your community, or if you're a runner or a fitness guy, uh, life is hectic. And so, one of the great things about passive investing is it allows busy professionals to reap and receive the benefits of real estate investing without having the day to day responsibilities of operating the asset. And, running rental real estate isn't always easy. Hot water heaters go, toilets clog up, some tenants don't pay rent, uh, trees fall through buildings. There's always something going on. And if you're a busy professional and you're already stretched thin, how do you find the time to properly manage a rental portfolio? That's kind of the real question, and that's where passive investing comes in. So, we offer people the chance to benefit by real estate investing. And I think the other point, particularly for people in tech, I would imagine many of them have a fair amount of their net worth in company stock that maybe they've accumulated by bonus, stock purchase plan, et cetera. My life partner, Laura, worked for Intel back in the day in Santa Clara when they were developing the Centrino chip, went to Visa and then Intuit that does Quicken. So she's very much in that world, employee stock purchase plan and this and that. So I find with tech professionals, much of their net worth is in company stock or other kind of stock. So real estate investing passively allows people to kind of diversify. And I think, especially now, but it's true all the time, the financial, the economic world can be a little crazy at times. I mean, stuff happens, there's volatility, there's geopolitical events, there's interest rates up, interest rates down. And so, in my mind, diversification is a way for people to kind of minimize risk. And so, when I talk with my investors, it's never take 100% of your net worth or your nest egg and go into real estate. It's how about considering putting a portion of your net worth of your capital into real estate and thereby diversifying? I'm a real estate guy. I would say 60 to 70% of my net worth is in real estate, but I also have 30 in the stock market through mutual funds and individuals. So I think one advantage with passive investing is you're able to diversify out of a stock heavy kind of portfolio, which I do think provides some security at any time, but particularly at times when economics may get a little choppy.
Yeah, comprehensive answer. I want to pick on the part of making sure that we really get the listener more of the benefits, right? We're talking, y- specific around multifamily investing, and you mentioned some of their two certainly. Also talked about thinking about the portfolio as a whole, which I really like. Don't put, don't cash out completely and go into something else, right? A quote unquote rebalance, if you will. But let's talk a little more about the passive investing perspective, right?
Yeah,
So deals are different. Different classes of multifamily for those listening. If you haven't already listened to that, there's episodes on that, A, B, C, et cetera, different types of multifamily and types of light value add, heavier value add, etc. But tell me a little about the other benefits that there would be for passive investors.
sure. So with a passive investment, a limited partner investor will invest capital with a general partner and operator. That's kind of what I do. The general partner and operator is responsible for the operation of the property. They sign on the debt. They're responsible for repayment of the debt, et cetera, et cetera. So a typical passive investment might be $50 to $100,000. So what do you get by investing 50 to $100,000 for that?
Exactly.
So typically you will get some kind of monthly cash flow or quarterly. So some operators pay quarterly, others pay monthly. So you'll invest your capital, you'll get a monthly or quarterly distribution over the period, over the hold period, which could range from 3 to 7 years. Just kind of depends on market conditions. So you invest capital, you get a return, and it's usually done via ACH directly to your account. So it's really great. And right now for multifamily, I'd say most of those returns maybe might be 5, 6, 7% on an annual basis. So the property operates over 3, 4, 5 years. The operator improves it, increases the rent, increases the net operating income, and therefore the value. And then hopefully at the end of the whole period, 5, 6, 7 years, you sell the property at a profit. And the limited partner investor gets the majority of the profit. Typically, you might see between 70 and 80% of the profit goes to the limited partner, perhaps 20 to 30% goes to the general partner. And the sum total of those regular distributions through the hold, plus your share of the profit at the end, plus return of all your capital, typically we aim to kind of provide a 2x equity multiple so that if you invested 50,000 over a 5-year period, you'd receive back 100,000 incrementally to begin with the bulk payment at the end. So that's how it kind of works. All the tax advantages in terms of depreciation and writing off of expenses and all that, uh, syndications are considered a pass through entity. Individual investors get K1s. So all the tax benefits flow to the limited partner investor in percentage of their investment in the deal. So if they own 10% of the deal, they get 10% of the write off. So the tax advantages do flow through to the limited partner investor. You don't really have any record keeping. You don't have to worry about what's being paid and when. You get a K-1 form at the end of the year. It kind of is the report card on the operation of the property, shows the write-offs, the income, the net income. You turn it over to your tax professional and you're done. So there's no kind of record keeping involved with real estate, which when you're an individual owner and you think about it, you own 10 properties. Well, you got to keep track of 10 mortgages, 10 property tax bills, 10 insurance bills, plus 10 income expense statements, and then pull them all together. So, investing passively does provide some ease in terms of the financial and accounting reporting. So, hopefully, I've kind of answered the question about how it
Yes, you
works,
did.
but I'm happy to go on further
Yeah.
too. Yeah.
I love how you went through all of that and talked about the total return, especially the return of capital as well. So I really appreciate that because it was succinct from start to end and just kind of hitting those points again, not only at the very end of the deal, how at the sale of the 3 to 7 year hold would you get all your capital back, but the total return on investment over time is basically going to be around that 50,000 as well, from income and from the sale distributions too. So that 2x multiple basically is what we look for.
Yes, and one other thing I would add, there's something called a pref return rate. And first, let me say, when you invest, there's always risk. Nothing is ever guaranteed. So the pref return, what that means, and typically on our deals, we'll do a 7 or 8% annual pref return. And the significance for the investor is as this money flows in from the operation of the property and the sale of the property, the limited partner investors get 100% of that pref return. Sometimes it's not paid current, but it's caught up at the end. But the way to think about it is the LP investor gets the first 7 or 8% profit or return off the top before the general partner shares in any of the profit above the pref rate, 7 or 8%. And so the way to kind of think about it is you're going in and you're working with the general partner, you know you're going to get 7 to 8% return on your money at a minimum, let's say, before the general partner receives any share of the additional profit. Uh, and the compensation of the general partner comes at the end of the deal and is strictly related to the performance of the deal. If the deal is just mediocre and doesn't do much, the general partner's compensation is extremely limited. But to the degree it does better, then their share it amounts to a significant amount of money. So limited partner investors will get that first 7 8% return, and then the percentage split is only after that 7 or 8% return is paid. And so that's comforting for limited partner investors because they kind of know we get first dibs on the profit, and it's only after it exceeds a certain level does the general partner kind of get a share. So important to understand what the pref is and kind of what the significance is.
Dude, thank you for covering that. Really, and the reason is because I still have conversations with colleagues and whomever talking about this. It's like, hey, this is possible, but even though the 50,000 or 100,000 won't break the bank, especially from the stocks that get vested or et cetera, it's still a sizable amount of cash, right? Versus what they might have invested other places. Maybe they bought their primary home and maybe they invested in a rental with someone else. It's still, but the question always is how do I know I can trust them, right? And so what you're asking about, what you're talking about, is really the answer to that, which is, well, the limited partner, the investors that come with LPs get money first. So it is advantageous. It is incentivizing the people operating it the right direction so that they need to work for the investor before they get paid.
Correct, and that's the way it should be. I mean,
Right.
it uh, I'm asking people to put their faith in me and trust me with their hard earned capital. And if I do a good job, I'm going to be compensated, and that's great. And most people don't mind other people getting compensated as long as they're doing well too, right? So if they go into an investment and it does great for them and the person running it makes a profit too, great. So it works out because it is very much the compensation is very much performance oriented. It would be like a tech salesperson. Their compensation is kind of based on how much they sell. And the more they sell, the better they do. Where if they don't sell a lot, then they maybe hit their minimum and their compensation's less, which again is logical and natural, right? If they
Yeah.
sell more software or more hardware, they should get more compensation. So it makes sense to me.
Absolutely. Absolutely. Appreciate you breaking that down. Really good kind of survey overview and a little bit of a deep dive too, really of the waterfall, really of how things are paid out, performance basis too. So another question I commonly get, it's really in the back of people's heads is okay, but the first one is what is the possibility of what happens if the deal goes sour? Right? What is the part that's not so much fun to talk about? What is the potential loss?
Yeah, great question, and certainly people who have been following the multifamily space understand there's been some rocky times the last year or two, and there have been limited partners that have lost money, no doubt. So, number one, I would say if you're an individual considering about making passive investments, first recommendation would be don't go all in on your first deal. Don't go all in with one operator. If you have a certain sum that you want to allocate, I would suggest you try two, three, four different operators, spread your capital, and then you'll actually see how they perform. So, number one, don't go all in, spread out your capital a little bit. The other thing I think I would look at as a limited partner investor is number one, what's the experience of the general partner team? Uh, I've been in the business 46 years. I've been through numerous economic cycles. I've been through the Great Recession. I paid 11 and three quarters mortgage for my first house. I sold real estate when I was 16. In the early 1990s, one third of all American savings and loans went under. Nobody even knows what a savings and loan is anymore. It's kind of like a bank, but it's a little bit different. So, with an experienced operator, they've been through rough times. Uh, and so to the degree you develop experience, uh, you're better able to navigate the inevitable rainy day or when Murphy's Law thing. So I'd look for kind of some kind of experience and track record in the operator. The other thing I would say, I'm a big horse racing fan, and there's a term horses for courses, which kind of means certain horses like running on certain tracks. And it's similar for operators. So somebody who's a great operator for a brand new Class A downtown apartment in Austin isn't going to be the best operator for some 1970s building in Lubbock, Texas. It's a different market, it's a different type building, it's a different type tenant. So I would work with operators that have a narrow niche specialization. So if they're in Dallas, Fort Worth, and they do suburban garden style apartments, and they've got five other style garden style apartments, and their current offering is a garden style. I think as an investor you can feel confident they know how to run those type buildings. And so for me, I'm in Greenville, South Carolina. The only places we invest is Greenville, South Carolina, because it's a market I know. I'm not doing high rises in New York City. I'm doing Greenville kind of garden style. So find operators who have a niche and some expertise with that type property in that type location, because they also then have the opportunity to build a team of property managers, insurance brokers, contractors. And anybody who's ever remodeled their home knows sometimes it's a little difficult finding a good contractor. So you need to build those relationships. Um, the other thing I would say is uh, I'm kind of an old school investor, and I believe real estate is a long term gain. The way I describe it is I try to hit line drive base hits as opposed to swing for the grand slam. Now, one can swing for the grand slam and occasionally hit it and everybody goes crazy, but there's more risk involved with that. Where with me, line drive base hits over a period 5, 10 years, you're going to win. So when you're evaluating deals, just don't look at what the return metrics are, the IRR, the cash on cash, the equity multiple. You have to ask yourself how reasonable is it that they're going to hit these targets. So if something sounds too good to be true, it may be, and I'd be a little bit cautious. The one other thing I would say, and my father taught me this years ago, uh, there's fundamental principles about real estate investing. And for me, it's one, fixed rate debt. Fixed rate debt is basically the keys to the kingdom. Most of the multifamily deals that are in trouble now had floating rate debt, which for homeowners would be equivalent to adjustable rate debt. It's the same thing, just a different name. So I really believe in fixed rate debt. I also believe in not over leveraging the property. So by that, I mean, maybe invest in deals where the loan value is 60 to 70% of the value, not 70 to 80, where the down payment's 30 or 40%, not 20 or 30. Also look at cash reserves going into the deal, because when you have cash reserves, then when the unexpected happens, which actually should be expected because something always happens, you have the capital to do it. And in my experience, the only time people get hurt in real estate is if they over leverage, have a lack of capital, a lack of cash reserves, and then something negative happens. Rents drop. There's a major repair issue. Now the operator might be in a situation where they have to sell in a down market. Where if you go into it properly, you just ride out the 1 or 2 year down. Because in my experience, real estate's usually up 5, 6, 7 years, maybe down a year or two, and then it goes right back up. I mean, in Austin, which is a great market, and it had a boom, boom run for 10 years, things have retreated a little bit, but to me, that's just the way of life. It's just the ebb and flow of everything. Does that mean Austin's not a good place to invest? I'd say heck no. Austin's still a great place to invest, but life goes on. It's the yin and yang, it's the flow in and out. And so Austin's retrenched a little bit, but if you go buy in now, you probably have a pretty good idea you're going to have a nice profit 5 to 10 years from now. So just go about it prudently, accept maybe a little bit lower return to provide some safety on the bottom. And that's how I kind of go about investing. Though, of course, other people approach it differently. And just to wind up, each investor has to kind of assess their own tolerance for risk versus reward. I tend to be a little more conservative, but that's just me. But assess that and invest in a way that feels good to you.
Yeah, I didn't want to say anything because I'm so looking forward to capturing that clip for you, Arn. But but just bringing that all the way back. Thank you for that answer. The question as a reminder, who is anyone who just got kind of lost in some of the nuggets there, was just you know as was mentioned earlier, nothing is guaranteed, but neither is technology and the way that we do things on a day-to-day basis, but the way that we especially in tech, do better is by making sure that we're educated. We're going through our checklists, make sure that we have the, we're putting aside a buffer, extra cash in the bank. We're knowing what our capacity is, and we're staying to what we know, right? Horses on courses
Horses for courses.
for
Yeah.
courses, and so yeah,
Yeah. And hey,
so
yeah, and so I'm a reasonably smart guy, not to brag, but I'm okay. But I, for the life of me, don't understand Bitcoin.
mm,
So I'm not investing in it. Now, I suspect you, being a little younger, tech savvy, you probably understand it. But for me, I don't understand it, so I'm not going to invest in it. Not to say people shouldn't invest in Bitcoin, but if you invest in Bitcoin, be sure you really understand how it works, and then you can make an educated decision.
yeah, exactly. Love it. Horses for courses. I'll
Yeah.
remember that one. So education and knowing and having the experience in specific things is literally how you de-risk yourself. Um, awesome. So I want to get through some of these others too because I think they're important points. Let's kind of rapid fire through this one just because it's a question I've
Okay.
been getting a lot lately. This isn't legal advice for anyone listening. Anything's definitely prefacing it for you, Arn, just for things that you've observed. But sometimes people get, I talk to have the barrier of, well, should I invest? Should I set up a whole LLC or should I set up all this stuff before I make, you know, a limited partnership, or should I do it in my name? Do you have anything that you've observed out there that you can say, or is this a definitely just go talk to your attorney conversation?
Yeah. Well, okay. So my own personal opinion is the benefits of an LLC are sometimes overstated. So honestly, I put most of my own limited partner investments in my name. Think about it. As a limited partner, one of the advantages is your liability is limited. You're not responsible for payment of the loan. You're not responsible for the operation of the property. Your total exposure is the amount of your investment, because basically you're buying into an LLC, which is typically a single entity LLC that's just specific to that property. So, in my mind, when you're a limited partner investor, you don't need to form an LLC to invest in it. That's how I do it. Other people have different opinions.
Totally. And if you have any other questions, go talk to your attorney. But I wanted to hear it.
Yeah.
Cool. I've done the similar for same rationale, and that's what I got to. So
Yeah.
I just like to get opinions to hear the different things. So I want to talk about one more thing is sort of you talked about the tech, investing in, we'll call it tumultuous times, with volatility. And I want to talk about this for a couple minutes here too, because right now there's ideas of the job market's going crazy, people are getting layoffs as well, but so oftentimes people will equate that to real estate markets, right? And you talk about real estate markets, if it's usually up 5, 6, 7 years, down a year or so, and then back up. That's a whole lot different than how it completely flows with the job market, right? So I'm just trying to make some distinctions here, and I'll hand it over to you for the question. But what are your thoughts around um, uh, actually investing in times where is it good to invest in any of the cycles? Are there always good deals to be found? Is it more important to be in the market versus trying to time the market and something like that?
Yeah, so I'm kind of more a time in the market investor than timing the market. To put it in stock terms, think about regular investment in real estate as being dollar cost averaging. Uh, I've been in the real estate business 46 years. And I don't know what the real estate market's going to be like 12 months from now. I'm sorry, I don't. I don't know what interest rates are going to be. I don't know what cap rates are be. Long term, I have an optimistic outlook. I believe in the American economy. I believe in the value of American real estate. And certainly people all over the world understand the value of American real estate. One, from the perspective of returns, but two, from the perspective of the protection of private capital that may not be the same elsewhere in the world. So when you think about wealthy people in China or India, they may be more interested in being sure their capital is safe rather than the return. Certainly, they're investing. So, long term, I think capital is going to flow in. Uh, the other thing I would say is investing is about quantitative, the numbers, the returns, but it's also qualitative. And so, for me, I look for quality in a building, in a location, in a market, because I believe ultimately quality will win out. So if I can find a good quality property in a location that I have logical and rational reasons to be optimistic about the future of the economy, and it makes sense to buy today, meaning it cash flows and it's basically self supporting, I'll make that investment. We bought $6 million worth of real estate in June. We're ecstatic we got the property. Uh, and the truth is, maybe the value of that property may drop a little bit more before it starts to go back up. But to me, the finish line isn't a year from now. It's 5, 7, 10 years from now. So if I can buy quality now and it makes sense today, I'm not so worried about the short term turbulence. So I'm more get your money invested. I think it's similar to people in the stock market. If you sold your stock the day after the COVID crash, one question is, well, when do you get back in the market? Who knows? And I can almost guarantee you, those who sold after the COVID crash are kicking themselves now compared to the people who did nothing and just wrote it out. And that's another interesting benefit about real estate. It's not as liquid as the stock market. And that might be a negative, and maybe sometimes it would be. But the positive of it is it reduces the chances of people making emotional decisions because with stock I can log on to my computer, push a button, sold. You
Right.
can't do that with a $10 million apartment building, and so it actually slows things down and allows some kind of non-fight and flight psychology to come in. So I think people should maybe consider that the relative lack of liquidity actually could be an advantage in turbulent times.
Yeah, it's almost like your father taught you some lessons about being VC and thinking long term there too.
Well, he was born 1921. Okay, so he actually lived through the Depression, and so uh, I'm a baby boomer. And baby boomers we know have had it pretty good. We are kind of born at the right time, let's say. So, but people are formed by the generation they grow up in and their life experiences that happen. So each generation has a little slightly different perspective, and you kind of got to take that as what it is and it's logical and so on and so forth. So living through the depression, you probably have a little more realization about the possibility of things going bad than perhaps other generations that maybe haven't faced those same kind of crises.
Yeah. Side tangent on that. I don't know if you, I mean, you talk about that. I mean, it's obviously lived experience for you too. But I don't know if have you heard the books Generations or The Fourth Turn?
I have not. I'll have to
Oh
check it
man,
out.
yeah, it's just again, it's kind of a side note because it's really cool. It goes back to those times, decades, time over time, and it talks about how, just like you said, certain generations grew up in certain conditions. And if you've ever heard of the phrasing, hard times create strong men create easy times, that whole cycle kind of thing as an
Yes.
example. But in any case, I like the illiquidity is a potential benefit because it doesn't allow you to make rash decisions. And I think that as a forcing function combined hopefully, with many of us in tech and investor minds and frames as well, we're thinking of not next quarter or 2 quarters. We're thinking of 5, 6, 7, 8, 12 quarters, which is much more long term thinking anyway. And so,
Yes. Yeah. And
um,
yeah, go ahead, Stephen.
no, no, please go ahead.
Well, I know we wanted to kind of talk about the cash flow versus appreciation
Yes,
angle,
please.
and I think it kind of flows into that. So, number one, every investor is different, and even a single investor, as they go through life, will have different needs, different desires with their investing. So, first of all, one size doesn't fit all. There's no one holy grail to what's the best way to invest. It doesn't exist. It's a very individual thing. And uh, many people, there's a kind of a continual debate about cash flow versus appreciation. And I tend to be a little bit in the contrarian space where my focus in real estate investing has always been about appreciation, about growing one's net worth. Uh, Now, certainly cash flow is necessary because you want properties to be self supporting, they've got to pay for themselves. But once that level's reached, then for me, real estate investing is about appreciation, increasing equity, increasing net worth. And I would just throw out for consideration with your audience, I would submit highly paid tech professionals, they have incomes that support their lifestyle. And they often have fun lifestyle. They take fun vacations. They got
Mhm.
recreational activities that they love to do, and sometimes those are costly. So my thought would be in these cases, their W-2 income, their professional income supports their lifestyle. So the goal of investing isn't necessarily to put more money in their pocket today that they could spend tomorrow. The goal of their investing should be to increase their net worth as rapidly as possible, because as net worth increases, then you can get to a place where you're work optional or you have choices. So for me, younger, highly paid professionals, my recommendation would be invest for appreciation, building that net worth. And I would just follow up and say, at a certain point of net worth, nobody worries about cash flow. At a certain point of net worth, that capital generates as much income as they want. So that's my 2 cents. And again, I'm probably in the minority where many real estate investors is kind of cash flow is king. Now, I would say if you're 70 years old and you've left your W 2 and you need income to survive, then maybe the scale tips to cash flow and you invest for cash flow. But peak earning years, I'd say invest for appreciation.
Look, let's break that down a little
Yeah.
bit. Um, Net worth defined assets minus liabilities, basically. And so you're talking about at some point in time that if you increase your net worth, then you won't really have to worry about cash flow because it will kind of take care of itself. I think there's context there that's probably important for maybe us to elaborate on here because someone could have, I don't know, high net worth, but it's all in their house, as an example. That's a problem. But it sounds like if I'm hearing you correctly and I'm interpreting this, it is invest for a larger sum of money that's liquid so that you can continue to reinvest that. Is that accurate?
Yes. So it would be investable capital or investable
There we go.
cash, right?
Okay.
So that would be the distinction. And the way I kind of look at it, one thing that I've always kind of a number I've always kind of come to is, I think I read some stat that typically here in America it maybe costs about 5,000 a month per person to live. And I would say that might be a typical kind of middle income lifestyle. So for a couple, you might need about 10,000 a month. It's a
Okay.
reasonable target to shoot for.
Mhm.
10,000 a month, it's not going to be jet set, but it's going to be comfortable. You can spend what you want within reason. Okay. So
Definitely.
my mind, if you reach 2 million of investable capital, and that would kind of be capital outside the equity in your residence. Good point.
Yes.
If you have 2 million in investable capital, you can safely generate a 6% return on that. The reality is you could probably do better, but when you're financial planning, use a conservative rate of return. If you make more, great. Don't shoot for 20% annual return and base your life on that and only get 10. That's a problem. But 2 million at 6% would be 120 a year, 10K a month. So in my mind, if you can get up to about 2 million of capital that you have invested, and that could be in the market with stocks earning dividends as well as growth in real estate. If you have that amount of capital invested, then I'd say you're close to achieving financial freedom. And then that opens up options for you as to what you can do with your time and what you want to do.
Yeah, yeah, certainly. I think to bring this really full circle and to really make a point on this, and you can please elaborate on this point too. The 2 million number might seem and sound like a lot, and it is a lot. Don't get me wrong. I'm not getting paid 2 million on my W-2 right now, but I think the idea of starting with 50K or 100K and having these cycles of quote unquote going full cycle of 3 to 7 years, you know, if you double the penny every year, right? 100,000, 200,000, split that to 400 to 800 to 1.6, etc. I mean, through the 20 years, you can definitely and certainly do it, and it's achievable. Not to mention, if you keep on investing another set of 50 and start that new path running every single time.
Yeah, 100%. And I probably even have a blog post about it. If
Mm.
somebody invests 50,000 a year for 10 years,
Right.
uh, you end up having about $1 million in capital. And typically you'll have about maybe 70, $80,000 a year in income. And so you're exactly right. It doesn't happen overnight. It's not get rich quick, but it's kind of a surefire. I think there's some stat 90% of all
Yes.
millionaires, and today millionaire doesn't mean that much, right? Being a millionaire today isn't like being a millionaire 30 years ago. Okay.
Right.
So it's just inflation. But the overwhelming majority of wealthy people, financially free, have made their wealth through real estate. And I think that just tells you something. So, I think that you hit the nail on the head. You're making good W 2 income. You're probably fully funding your 401k, which, by the way, you can use your self directed IRAs to
Hmm.
buy real estate. And so people should kind of look at that and understand that. But if you're making a high income, you probably have a delta between what you're earning and what you're spending. And of course, the real key to being wealthy is live off less than what you make and invest the difference. And it doesn't matter if you're making 50,000 a year or 200 a year or 500 a year, the formula is still the same. Live less than you spend. And of course, that's difficult because you make more money, you want a nicer car, a bigger house, and you can kind of get on this consumerism wheel. And I've fallen guilty to it too at times in my life. But to the degree you can resist that, put that capital to work for you. And even incremental investments of 25, 50 a year over a 10 to 15 year period. I would say it wouldn't even take you 20 years to get there, but I think a 10 to 15-year period is reasonable. Now, in our space, many syndicators kind of talk about, well, I'm going to invest with me and you'll be financially free in 3 years.
Hmm.
If you believe that, you need to maybe reconsider and recalibrate. I mean, life is what it is, and we know. So, but 10 to 15 years, you can definitely make it happen. So I totally agree.
Thanks for elaborating on that with me. I think hearing the number, like the math checks out obviously, but the path is sort of the missing bridge on how to get there. And I mean, if you're doing 300K, and 350, whatever, going to invest, first of all, you should be able to live off that and excess from your paycheck. And taking some of the things that you get from vesting your stocks, and taking that and putting in 50,000 into these types of investments once a year. I mean, that's it. Just keep doing that. And as you earn more, keep doing that. So,
Exactly. And I always tell people it's maybe not so much even what you invest in, but it is that you invest and you
yeah.
try to maximize the capital that you invest. The picture I always get in my mind is with the capital that I have invested, every morning those dollar bills get up, put
Hmm.
their suit on tie, get their lunch pail, their tool belt, and go to work for me, and I could be out golfing. I love playing golf. So think about those dollars, those capital invested. They get up every day. And in fact, they never sleep. They work for you 24/7. Every day they're working for you. And that's really how you kind of create wealth is put that capital to work long term.
They're your employees. Be a good steward. Yeah.
Yes. And they don't talk back and they don't need lunch breaks or anything like that. So it's okay.
Absolutely. I want to be conscious of your time. I'm loving this, Arn. I really appreciate you being here in this conversation. Well, as we close out, you certainly have learned a lot from your experience, not only from environment and just things you've been exposed to. Super cool to meet you as, Sandy Hill, but also there's probably a lot of things that were just kind of from environment too that you've probably become aware of over time, and picked apart. So, sort of teeing up the question here is, knowing a lot of what you know now, I love to ask this question to my guests is, when you were first starting out, what would you tell yourself?
I'm very forward looking. I don't spend a lot of time thinking about the past. I kind of deal with the future, but I think the answer would be better with your money if you can, if you're mature enough in your 20s is better than waiting to your 40s to do that. And everybody wants to have fun and all that, and you go to school, you get a good job, you're making money, and you want to kind of enjoy the fruits of your labor. But I would say to the sooner you can get disciplined about your spending and maximize your investing, the sooner it's all going to come together for you. Uh, and I walked that path too. I started I had my two sons when I was probably 34 and 36, and that's what really kind of matured me and got me a little more disciplined financially. But the truth is, if I had gotten disciplined sooner, it would have even been better. So, kind of educate, get disciplined financially, be smart with your money. As soon as you can kind of get to that place, it'll serve you well long term.
Outstanding. Arn, thank you so much. Tell me and the listeners, where can they engage with you? How do you want to be engaged with? Where can they find
Yeah,
you?
yeah. So I'm active on social media, either on Facebook or LinkedIn, other under Arn Cenedella or Spark Investment Group. Website is investwithspark.com, and reach out. Happy to chat and talk real estate and anything else. So yeah, it's been a pleasure meeting you. Enjoyed the conversation and kind of the deep questions. So it's been great.
Awesome. I'll make sure all those things are in the show notes as well. I mean, I want to keep chatting with you about investor stuff too. Go reach out to Arn and team. Get your questions answered, as he was just saying. Sooner the better, and start getting investing. Arn, thanks so much. Take care.
Thanks, Stephen. Thanks, buddy.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.